Okay, good evening. Welcome to the weekly take on the market. Today is actually Thursday. It's Thursday evening around 6 o'clock Pacific Standard Time. Uh, Going out of town for parent weekend at my daughter's school tomorrow, so I had to do the video today. Um, my name is Scott St. Clair. I got distracted for a second. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed, can't tell you what to buy, what to sell, what to hold. You guys know the drill. We'll do the market indices. We'll talk about the market. It's quite a market. And then we will do, well, I had good trade, bad trade, but I haven't really had I've had some okay trades. So I didn't really have anything that's been all that good. The market's kind of changing on us, I think. So I'll go with a bad trade, and then we'll do the stocks to watch. I have a lot of stocks that I think we can review, and then we'll do the quote of the week. So market indices, and let me make sure that I am sharing my screen correctly, because there's nothing worse than when I mess that up and have to redo the video. That has happened to me before. Okay, and I'm going to turn off my camera so you can see the charts better. So the indices, somebody tweeted this. I don't know who Steve Putz is, but I'm going to assume that he did the math right. Talked about the Mag 7. They account for 37% of the S&P 500's value. 20 stocks account for half the S&P. This is why there's an adage, it's a market of stocks, not a stock market. And I think that's more and more prevalent, which is why, for me anyways, I know other people love to use the indexes, and I guess there is some, they can make something of it. And I still look at them because you need something to compare to. Like how I got to have, like, I love the relative strength lines. So I got to compare it to something. So I still think the indexes are important, but I don't think they're as important. They do. It's like a poker game, a gigantic poker game, and the indexes do a really good job of masking their hand. They are one of the, if you don't want to be in a poker game with the indexes, they're too good at the game of poker. So 480 stocks make up the remaining 48% of the index. So if they were equally weighted, it'd be only 0.1% of the index per stock. So when you see like a Chipotle gap down 20%, it just doesn't mean anything to the market anymore. The market, all it cares about is Nvidia, Amazon, Tesla, etc. I thought I had another screenshot, but I guess I don't. Okay, so before we go into the good trade, bad trade, let's pull up the indexes. And I know this isn't perfect, but it's worked for me. And you kind of poked your head up out of there, and now you're coming back in. We're still above the 50-day. We're still in this channel. I don't want to get too bearish. I'm fairly certain IBD will lower exposure today. They'll go from 80 to 100 to 60 to 80. I probably would have gone lower, 40 to, I would have gone down 2 notches. They just don't, I don't think we've ever gone down 2 notches or gone up 2 notches in a single day, but it's not that we can't, we just probably haven't done it, I don't think. But I don't like the market here. And Monday I didn't, when I was on IBD Live, I didn't like the market. And I was, what's the word I'm looking for? It's killing me. Basically, I didn't want to get too bearish because I was having a tough day on Monday. So I wasn't sure if it was more me and the stocks I was in or the overall market. But one thing I noticed on Monday is Tesla. So Monday, I think this would have been Monday, for Tesla was up 3%. Amazon was up 4%. Nvidia was up 2%. And I didn't think that was bullish. I know some people might think that's bullish, but to me, if you don't like the market, if you're a big pension fund or a big hedge fund or a long only mutual fund, you don't like the market, what do? Well, you can't go to cash, can't get short. Maybe a big hedge fund could, but so you hide, quote unquote, hide. And how do you hide? You hide in Nvidia, Amazon, Google, Meta, Microsoft, because you can't really get hurt, so to speak, from a career standpoint by being in that stuff. If this market melts down, it turns into a big bear market, and you're loaded up in Oklo and in Rigatoni Computer and NBIS and CoreWeave, you have career risk. And I'll tell you that career risk is very real. I felt it at William O'Neill when I was running money there. I was always worried about how I was doing against the indexes. I was worried about how I was doing versus my peers. I was worried about how the upper echelon of people at O'Neill who allocated the money, what did they think about my trading style? What did they think about the stocks I was in? What did they think about my exposure levels? Was I too risk averse? Was I taking too much risk? It just drove me crazy. I was just bananas with thoughts. I couldn't make a decision cleanly, so to speak. So career risk is very real. I don't have that anymore. Mostly just run friends and family money, and yeah, at least I've gotten rid of that. So I still have qualms about the market, and I don't want to lose if I can help it. But I don't. The career risk part is gone mostly. So that just adds a whole nother line item into your mental accounting and just makes everything very tough. So I think that's what's going on there. They're hiding in these big stocks while the rest of the market feels like it's under distribution. So let's look at the S&P. Oh, I already looked NASDAQ. I mean, it's not even below the 50-day. Bear markets occur down here. Like if we get into a bear market, let me show you what a bear market looks like. And everyone talks about the 2000 bear market, but this is what a bear market looks like: big, wide, and loose around and below the 200-day. That's what and a really bad bear market gets big, wide, and loose below the 200-day and the 50-day. Look how it cannot get above and hold above the index. So it's like a ceiling. And now this is a really bad one. Let's look at like the S&P currently. So you're still not there yet. I don't want to get too bearish, but I tend to get pretty defensive pretty fast. Right or wrong, it's my nature. It's the scorpion and the frog story. And so it helps me sometimes and hurts me other times. Probably hurts me more often, but when it helps me, it really helps me. The magnitude of what I'm trying to protect myself from is very large. So every once in a while, that trading quirk that I have really helps me. But most of the time, it hurts me. I get out of good ones, they go up. I get out of them on little wiggles, they go up. So let's look at like, how about like a real, not a garden variety bear market. So this is 1990. Let's go out a year. And you should do this. You should look. And so you can see how it breaks the 50-day, then it breaks the 200-day, and then it just starts living below it. Can't get above it. You got a little test. And then it finally gets above the 200-day. And somewhere in there, there's a follow-through day, probably, that maybe there, somewhere in there is one. And now you've got kind of clean sailing, right? Because you're above the moving averages. This is kind of an old school bear market, 1990, 1994 to 95. So let's go to 95. And not that bad a bear market, right? But you had a little false sense of hope here, and then it breaks below the 200-day, breaks below the 200-day. So, once it gets above the 200-day and above the 50-day, these aren't really indicators based on the IBD methodology, but I would guess or bet if you asked a lot of the traders, the Charles Harris, the Mike Websters of the world, David Ryans, they would probably say the same thing. So if we go to how about like well, I'm not a big fan of using these really bad bear markets because I don't say they're easy, but they they're what's the right way to explain that they're really bad bear markets. But bottom line is, look, it can't get above the two moving averages, can't get above them, can't get above them, can't even really stay above the 50-day. You're below the 200 days. You see how it just keeps you out of trouble. You can, you get a follow through day or something. You can always try. You get 5, 10, 20, 35% invested, and then it doesn't work, and then you're out, and then you're 5, 10, 15, 20% invested, it doesn't work, and you're out, and you kind of get mixed up. And so from here to there, maybe you lose 8, 9, 10% of your account, but you don't go down with the ship. You're not going to lose 50%, 70% of your account, which is really, really difficult to dig out of. So we're basically in no man's land. I don't want to get too negative, but I don't like the action. And I know a lot of people talk about the indicators like the greed and fear is people are fearful, and the AAII sentiment numbers that stuff hasn't worked in months to years. So I'm not sure if it's going to be a good signal to tell you that, oh, people are super bullish or super bearish. Just look at the price. What's the price doing? And if it starts to get below some of these moving averages, then that will be a tell, I think. But for like the Bloom Energies and the NBISs and the Oklos of the world, man, if you wait for the S&P to go below the 50-day or the 200-day, you're going to be taken out in a stretcher on some of those names. So you just use your normal risk management selling strategies, whether it's offensively or defensively, because you're going to be way, way too late. And that's kind of what's going on right now. It feels like the first shots across the bow in a lot of those names. IWM, not a whole lot here. I think this is the canary in the coal mine, Bitcoin and or Ethereum. And you had the shot. Well, when did that one like after hours meltdown occur on all those altcoins and the crypto universe? Maybe somewhere in here. So that was, and you're just below you're below 200-day. When's the last time that the IBIT closed below the 200-day? Was in April. It's been a while. And if you go to the weekly, you can see like the last time it's closed, and we're not closed yet, but by tomorrow, the last time it's closed below the 40-week line. Now I'm using the IBIT, the ETF. The last time it's closed below that was never, okay? Because it didn't exist. So it just started, it had enough weeks here at 40 weeks to above it. So you see 40-week, 3.9%, 40-week, 8.3%, 40-week, 4.3%, 40-week minus 2.9%. So this will be the first time this ETF has ever closed below the 40-week line. Probably. Let's wait till tomorrow. Remember, today is Thursday. And then Ethereum as well. Now this is the levered one, so I don't want to use. Let me go to ETHA, which is not levered. So you've broken below all of this. You've broken below this. So maybe it's a shakeout. Who knows? Anything's possible. But if it's a shakeout, it's a pretty good shakeout. We'll have to wait and see. Okay, so I think that's it. Oh, gold. I don't know what to make of gold. This looks a little bear flaggish to me. You're still above the 50-day. It's made a big move. I do own a gold stock, Newmont, coming off 50-day. I guess I can pull it up. It looks like it's coming off the 50-day. I bought it here, and I actually bought a little bit more today, and then it didn't close all that great. We'll have to wait and see. But if the institutions ever run to gold, Newmont, they almost have to buy that, because I think it's, if I'm not mistaken, it's the only gold stock in the S&P 500. AEM is a good one as well. That's probably a better quote unquote company than Newmont, but I'm just going with the idea that the institutions would, if they ever wanted exposure, they would buy Newmont. Let's see if I don't think none of the IBD mutual fund index funds have a position, and none of the funds that I follow have a position in this as well. So tells you what they think of gold. They've never liked it. Okay, let's see here. Let's go to the good trade, bad trade, and we're going to go with just the bad trade. Is it INSM? I think is the one, and I think I bought INSM somewhere in here. Let's backdate that. Based on the fact that Druckenmiller had a position in it, and you had some strength, gaps up and holds the gap, but you could see how it just slowly but surely did its thing, never really did anything wrong. It's kind of meandered up, and I just got bored with it. So I think I paid in the 96, 98, something like that. And who knows, maybe I got chicken out there. I don't remember how long I held it, but I sold it out of boredom, which is a terrible, terrible way to sell them. I almost always regret those sells out of boredom. And unfortunately, I tend to do that more than I should. But so here I am in at 100, stocks 185, holding up great, and never even barely broke the 21-day moving average. So it's a lesson in patience, 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 patience. I'm trying to get better at that, but it's still not quite there where I am. And part of it is because I'm always trying to have size. So I want to have, a 20% position. I want the darn thing to move from 100 to 120 in 4 days. And I think, well, why can't I just have like a 6% position and let it move from 100 to 140 in 40 days, and probably make the same amount of money with less risk, half the risk, if not more, right? So I have a lot to think about from a position size standpoint for when I do my post analysis next year or at the end of this year. So that's the lesson for is patience. Let's look at the leaders. So stocks to watch. Some guy that I follow on Twitter, he said the leading stocks right now, and he listed a bunch. And I thought, oh, I like all these names. Let's. This is where I got the INSM reminder that I messed that up. So Bloom Energy, obvious leader, acting really well. I mean, 2 days off the high, holding up like a champ. I bought it here. I had no idea they're going to announce earnings there. So I bought it there, pilot position, thinking I would add as it went above that. And it went above it in 1 day. And so I sold it, which is typical of how I mess these up sometimes. But this is acting really, really well. Now, NBIS, still above the 50-day, but this does not look as good to me. You can see how you're mostly blue in here and kind of sideways, mostly blue in here. And then you start to get these really big pink bars. So you got, down 7.8%, down 4%, down 6%, down 8%, down 7%. And so this looks like it's under a bit of distribution to me. If you have it, maybe you want to give it more room. It's still above the 50-day, but this looks like under distribution to me. And that's a leader. So there's a clue, right? One of the leaders looks like it's under distribution. Now it's a speculative leader, but it is a leader. Now here's Hood, definitely more quality leader. You got bounce off the 50-day, bounce off the 50-day, bounce off the 50-day. Fourth time is not the charm. I don't think it's going to hold the 50-day this time. And it does it on really good news. Look at that quarter, right? 259 plus 100. So that's a tell. When stocks go down on really good news, that's a tell. That's important information. When stocks go up on bad news, that's a tell. That's important information. So there's a signal here with Hood and with Palantir. I don't want to read too much into it, but I think there is a signal of what these stocks did. Palantir, another tremendous quarter right there. Stock was up after hours, opened down. I actually shorted Palantir there because of that. Just on that one signal alone, I thought stock should be up. Why is it gapping down? So I am short Palantir with a inverse ETF. So those are a couple of signs that have me a little wary and slightly to moderately negative on the market. I do have a couple of longs, but I have more exposure on the short side. I'm not out there on a limb either way. I would say my net exposure is probably 20% long or 25% long and 50% short, something like that. So I'm net short 25%, if that makes sense. So if I had a dollar in one account, well, let's make it easy for you guys. $100,000 in one account, I have $25,000 is long, $50,000 is short, and $25,000 is sitting in cash, right? That's how the 100 adds up. And that's kind of probably where I am, give or take a few percentage. Let's look at CLS, holding up really well. And these are great to review. These are stocks, if you didn't own these, you should review these ones. Palantir, Hood, NBIS, Bloom Energy, what other, CLS. Market comes out of the correction. You get the whole tariff throw up tantrum stuff that kind of comes and goes. You get a follow through day in the market. And what were the best stocks showing relative strength? These were some of the best names. CoreWeave. So new issue. He has this as a leader, and his tweet was on October 31st. Give you an idea on when that was. He had SYM. Now, price-wise, I agree with him. I don't know if this qualifies quality-wise as far as a leader, but these are stocks that I would buy. I have it bought Symbotic. I can't remember. I think I might have bought it here or somewhere in here in traded it for half a minute. So price wise, I have no problem with it. I don't think it qualifies from a quality standpoint. STX, definite leadership, holding up okay. Credo. So you have a bit of a potential failed breakout. A-Lab, he didn't have A-Lab on there, but I want to pull up A-Lab because you can see how it goes from mostly blue to mostly pink. And it looks a little bit like, it reminds me a little bit of like NBIS. And again, this was a really good quarter on paper. In a vacuum, that was an amazing quarter, and the stock went down. Okay, these are tells. He has INSM, which I talked about. MU, holding up like a champ. Palantir, which I talked about. Ubiquity, holding up very well. I've never owned this. It is an $800 stock, but it's just the volume has really kind of kept me from owning that one. Comfort Systems, Fix. So these are some of the leading stocks, and they're not broken by, most of these I've shown are not broken. Some of them have maybe some tiny warning signs, but most of them are not broken. So that's kind of the leadership that he talked about. I would include like Light. I think this is a leader. Sienna. These are ones that he didn't mention or I missed, and they look like leaders to me as well. Now, it's a market of stocks, not a stock market, and so you have some disasters out there. So like Duolingo, which was one of the leaders, right? Came out, one of the first stocks to come out, blowing up 65%. This is why we have sell rules. ELF, 50% off the highs. And honestly, probably even worse if you include that. And look at this action. These are not stocks. You don't want to buy this type of action. It's just too many big pink bars, in my humble opinion. How about Chipotle? Right. So where was the relative strength? Like this looks like what I'm talking about with the indexes, right? Breaks and they can't stay above the moving averages. How about Fiserv? So there's some really bad action in some name. How about Sweet Greens? Remember Sweet Greens? That was all the rage. Remember Kava? We all forget about how bulled up everybody was on Kava, right? They're all bulled up on it. You know, if they're gonna go from 50 stores to 5,000 stores, and you get the calculator out, and that's fine. But when the facts change, you need to change. And whether it's the fundamentals are changing or the price action is changing, usually to me, it's the price action. And I think if you go here, this is a really great clue. Let me just kind of explain. A lot of you probably know this kind of rule. It's kind of a time-tested rule with markets, but this is like the Palantir and the A Lab. And what was the other one that had really good earnings that that didn't act correct? And this is an earnings day. The stock ran up and closed very poorly, and then tried to hold and then broke bad. And so you had quote unquote good news, and the stock did not confirm that good news. That's a warning sign. CRM, relative strength 20. What's that telling you? Adobe, oops, ADBE, relative strength 16. What's that telling you? What about Microsoft? So it's 70, not that bad, but so announced earnings right here. And I don't know what the street thought of the numbers. I'm going to guess that they really liked them. They're not all that dynamic for the size of this company, though, 23 and 18. That's pretty good. Margins up 68%. Stock tries to go up, couldn't. How about Meta? Now, this looks like it's slowing down a little bit, 2026 versus what they're doing, and the stock gap's down below the 200-day, and you're just kind of bleeding so far. Still early, but that's not acting all that great either. And then you have a couple of others like in the loan area. So like UPST, I am short this stock. Looks like it's rolling over. CACC, I am short this. Looks like it's breaking support. And I want it to stay down there, but so it's really a market of stocks. There's some stuff that looks like it's going down and going down with the ship. Like they look really bad to me. And there's a lot of stuff that looks really good. So in the metals area, like ERO had a really it started to have a really good day today. I am long this one just for clarity. It didn't close all that great, but it's still a 5% in a bad tape. And you see it's bouncing off the 10-week line, runs up, pulls back. It's bouncing off the 10-week line. It's blue and kind of a bad tape. And this is the kind of the critical minerals / metals area that maybe the market could possibly run to. I don't know. HBM looks very much like that, runs up, nice and constructive back. It's on the 10-week line. So the jury is still out. I am long those two names. If they break the 50-day, I've got to go. But I'm trying to give them a little bit of room to breathe, just in case the market likes them. I did buy a little BABA today, bouncing off the 50-day. I go back and forth on Alibaba. I just do not know how to handle this stock. Sometimes I think I want to really be all bulled up on it, and sometimes I don't. So, but it's on the 10-week line. I told myself I sold it fairly well into this rally up here, and I said I had been very patient. I avoided this. I've told myself if it comes back to the 50-day, the 10-week line, I'm going to buy it. And because of the market sputtering, I didn't in last buy it 2-3 trading days ago, but I pulled the trigger today, in fact, with a small pilot probing style position is what I would call it. I think that's enough. Definitely covered a lot of stocks and kind of give you an idea on what's out there. All right. So, here, I forgot that I wrote these down because I didn't want to forget that which names that I wanted to go over, because sometimes I'll write them on a sheet of paper and then I'll throw the sheet of paper away and forget. Anyways. All right. So I think we are on to the quote of the week. David Drews, I think that's how you pronounce his name. He was on a podcast called Top Traders Unplugged. It was a two-parter. The first part was about him. The second part was about his time as Ed Sekoda's apprentice. Now, Ed Sekoda is probably one of, if not he's definitely one of the greatest traders ever, and he might be one of the greatest individual traders ever based on his kind of unpublished track record. But David worked with him very closely. And in the second part of this interview, he talks about his experience with Ed Sekoda. I would listen to this podcast. You can listen to both of them. I thought both first and second parts were great, but the second part I found very fascinating in that the way Ed Sekoda thinks, and Ed Sekoda, if you don't know, was featured in Market Wizards, the original, but the way he thinks about psychology was very fascinating. So David says he's very, very big on psychology. He has a saying, everybody gets what they want from the markets. He was very big on trying to understand your own psychology. And I just think the longer I do this, the more I think it's not about interpreting the cup with handle correctly. It's about your psychology. I should have made really good money in INSM, and I didn't because of my psychology. I got bored. And step one is to know that, and then step two is to combat that, to do something to avoid that, whether it's a rule or something like that. It's great to have rules, but if you don't follow the rules, what does it matter? So I would listen to that, and I think psychology is so important. I have every morning I have like my little journal, and I'll write down my psychology. I have what I call like my definite chief aim. I think I stole that from Napoleon Hill. My definite chief aim, and how I'm going to my definite chief aim from a wealth standpoint, my definite chief aim from a health standpoint, and I just try to ingrain myself by repetition, by repeating these mantras in the morning before I start. And one thing I say is one thing in my mantra is each morning my mind is empty. I really want to just be open and empty to what the market is telling me. I don't want to come in with these preconceived notions. So I wake up in the morning, my mind is empty. What is the market? What's the message of the market? I am not playing against the market. I'm playing against myself. A lot of people have this adversarial relationship with the market. Well, guess what? The market's going to win. You're going to go broke if you're adversarial against the market. So I'm not playing against the market. I'm playing against myself. If I'm whatever I perceive as wrong, the market is not wrong with the markets. It's wrong with me. It's wrong with my psychology. I need to get in line with the markets, not the other way around. So food for thought. 800-831-2525, market surge at investors.com. Appreciate the feedback that we get, and let's see what happens tomorrow, Friday. Last not least, I don't know. I don't want to get too negative on the market, but I didn't go over the stocks, the speculative stocks that are really, to me, giving a signal that the market might be changing a little bit. So like Oklo, the LEU, UUU, The quantum stocks look like they've, I hate to use the word top, but I'm going to. Um, the so there's the whole speculative fervor of where the big speculative money was being made feels like that game has ended. And so let's see what that message is overall in the next handful of weeks. All right, I should be back next week. Have a great weekend, everyone. Thank you guys. Bye bye.